Hello and welcome to this month edition of the Unio Market Update. My name is Fitzgerald. I'm joined as ever by my colleague Alex Kinsella. Alex, how are you?
I'm good, Jer. Thanks very much. Glad to join you today.
Great stuff. Listen, let's get straight in. Equity markets have added a little bit of volatility over the last month.
Yeah, no, absolutely. The September is a pretty miserable time for stocks, and I suppose that's where the term the September effect came to pass. It's actually the fourth year in a row, I think, that markets have ended up negative for the month of September, but it's not actually been to do with some sort of a hex on the markets heading towards Halloween. It's actually really this month was primarily focused on oil and the Federal Reserve being the two factors that drove markets downwards a bit. There's been a growing sense that central banks are going to keep interest rates higher for longer, and then coupled with that was a $20 increase in oil prices during the last quarter. So the compounding fact of that saw the S&P falling about 5% and the Nasdaq dropped about 6% for the month in local terms. So pretty much the worst month of the year for both of those markets. So there's the worries about sticky inflation and the Fed interest rate hikes driving these losses. And if you look at the chart here, you see growth equities and then the broader market and value equities. You see the sell-off on that growth side. So interestingly, that those big mega cap stocks, Alphabet, Amazon, Apple, Meta, Microsoft, Nvidia, Chelsea, and Tesla, they powered a lot of the market gains during the first half of the year, but they really struggled in September. I think of that big seven, only Meta and Tesla ended the month actually positive. All of the others dropped, some of them down as far as 10%, wiping huge amounts of off their valuations, hundreds of billions of dollars off their valuations. But a lot of the reason behind that, as I mentioned, was the fact that the market looking at the Federal Reserve and where interest rates are going, and they're going to stay there for longer, and that impacted obviously bond yields quite significantly, which in this slide actually we can have a look at.
So absolutely, and what we've illustrated here is just a long-term movement in a 10-year US bond, a US Treasury, and over the course of, I suppose, beyond the last decade, I suppose the cost of borrowing for the US government has been, I suppose, pretty cheap. But currently, a 10-year US Treasury is in around 4.8%, actually at a level that we haven't seen since May 2007. And this just really relates to the fact that the US Federal Reserve has raised interest rates on the back of where, I suppose, the prevailing inflation has been at. Now, I suppose over the last month or two, the story has evolved from has the Fed, I suppose, reached peak rates in its interest rate hiking cycle versus have they got a hold of inflation. Whilst we have seen inflation at the near term, like the 1-year outlook or the 2-year outlook for inflation from a US perspective, what the market seems to be readjusting for at the moment is the outlook for over the medium term, over the next 5 to 10 years. The inflation outlook is actually a little higher than would have been perceived a number of months earlier. And really, I suppose that persistency and stickiness of inflation continues to prevail. And this has brought a realization with it that the US Federal Reserve is going to keep rates elevated for longer, and hence you see here at the 10-year point, those rates have continued to rise to currently 4.8%. Now, if we bear in mind the inverse relationship between yield and valuation, given these higher movement in yields, in turn it comes through as a negative return over the period. If we were to look at, say, a Eurozone government bond, the rate of rate rise or the rise in yield hasn't been as significant, But nonetheless, over the course of September, a Eurozone government bond would have been down in the order of about 2% to even 5%, depending on the maturity or how long those bonds have been. So I suppose, Alex, you had spoken to the fact that equities were down over September. It was the same sentiment within the bond market, generating negative return. And looking forward, I suppose, to the month ahead, really, I suppose we're looking at inflation and Alex, kind of tying in what you had said, you've spoken to the fact that the cost of energy and commodities had risen. The likes of a barrel of oil increased by $20, and this is going to have an impact on headline inflation. The cost of going to the petrol pumps increases, and obviously this kind of feeds through. We've been through this cycle before, and how long that lasts. From a central bank policy, there's I suppose the key interest rate decisions from the US are the start of next month, and from the ECB or the Eurozone perspective towards the latter end of this month. So there's a little bit of a reprieve over the next number of weeks, but nonetheless the questions are the same. It's a case that have we reached the point now that we plateau for a period of time, or ultimately is it time for, I suppose, the fundamentals from the respective economies, from an employment and GDP perspective, to push central bankers into the kind of mindset of looking at reducing interest rates. So we're at quite an interesting time within the bond and the credit cycle, and we can see now that has fed through ultimately to equity markets as well.
Yeah, absolutely. Yeah, I was just gonna jump in and say, that the compounding that then are more economic issues such as the China and the West trade concerns. So these, if we step back, we've had a trade war emerging since 2018, back in Trump's time in charge of the US. A trade war kicked off, and it's been pretty much going since then, and it's really reaching elevated levels at this stage, and even down to the fact that we're now seeing the European Union sticking their oar in as well, and looking at or highlighting their concerns with regards to their ongoing relationship with regards to trade with China. And then even looking as near as yesterday, the big news in US politics, where they ousted the Speaker of the House, McCarthy, I think the first time that's ever happened, and that really throws up a sense of flux in the US political sphere, and that is going to have ramifications for markets. We may see a little bit of volatility creeping in, and particularly, I think, if you jump forward into next month, we've only just gotten over the hill with regards to the debt ceiling last week. This is going to reemerge next month. So McCarthy was an integral part of trying to agree the increase to the debt ceiling. Let's jump forward a month's time. If they don't have somebody in place at that stage, or whoever is in place may not be as forthcoming. So it's going to be interesting to see how that impacts markets, and it may provide a little bit of volatility over the next period. So a lot to look forward to over the month ahead and keep our eye on, Ger.
Absolutely, certainly enough to keep us interested. On that note, we might just look to wrap up this month's edition. Thank you very much for joining in, and we look forward to speaking with you all again next month. Thanks, Alex.
Thanks very much. Bye.